Good morning and welcome to another 5 with Fitz. I'm Keith Fitz-Gerald. Thank you, as always, for joining me. You know, we begin today with all three indices, the Dow, the S&P 500, and the NASDAQ in the green during the pre-market trading, but that very quickly gave way to the split between the Dow and the S&P 500 having turned red as I record this, and the NASDAQ, of course, was still green. Now, my guess is that any dip won't likely last long, maybe even by the time you watch this. What makes me say so? That's the real question. As you know, if you've been reading or watching this video, The 5 with Fitz, for any length of time, I've been increasingly vocal about the fact that I think there's a short-term fight brewing between the go-fast gang and long-term investors. Now, A, that's perfectly normal, and B, this kind of seesawing is consistent with that hypothesis because it means there is a ginormous battle for positioning, long or short, doesn't matter, behind the scenes. So keep in mind these two things. First, the short-term crowd almost inevitably loses money longer term, but that doesn't stop many from pounding their chests whenever there's a blip and insisting they're right. And second, the world's most successful investors focus on being profitable even when they're wrong. Now, why does this matter? It matters for one simple reason, because the sooner you learn to stay focused on great companies putting up great numbers, the sooner your portfolio will thank you. According to FactSet, roughly 64% of S&P 500 companies have reported so far, and of that bunch, roughly 83% of S&P 500 companies have posted positive earnings, 83% of that bunch, while 79% of them have topped revenue estimates. The blended growth rate now sits at 10.7%, which, if it holds, will mark the fourth straight consecutive quarter of double-digit earnings growth. And that, mind you, is up significantly from the 7.9% that sell-side analysts expected at the end of September. Once again, it's proof positive of something you hear me say frequently. Investing in optimism beats cowering in pessimism. Wow, I love this job. Anyway, speaking of which, Palantir will be $1 trillion company within the next 3 to 5 years. I was honored to be invited back for another conversation with the venerable Stuart Varney this morning ahead of today's opening bell. Palantir and AMD are reporting this week, and he wanted my take on what's next, if I'm buying, and where do both companies go from here. I hope you watch this video elsewhere on the channel because it is powerful and I think fun. It was a wonderful interview, and it's great to be back every single time. So thanks in advance for watching it. Now, of course, I will have some additional thoughts on Palantir for the One Bar Ahead family later this morning, along with two very high probability, very specific high probability trade ideas, if that's something you want to deal with. Anyway, number 2 today. If you're worried about valuations, watch this, and watch this, or technically read this, and read this in the written version of 5 with Fitz. Now, there are loads of folks who are worried about stratospheric valuations right now. And I get it, particularly when it comes to Palantir. Fine. Just don't conflate what's probable with what's possible, right? Now, I talked about that in last night's Sunday short, but just in case, there have been plenty of super high value companies that have made investors who own them millions, perhaps even billions of dollars as they ebb and flow over time. So we're going to talk about that again in great specificity. Here are just a few examples along with key Keithisms to keep you on track. Tesla, the PE greater than 1200 was just the starting line. Tesla once traded at a PE north of 1,200, as in 1,200, and it was dismissed as insane overvaluation. Yet, from its 2010 IPO to peak, it delivered over approximately 17,000% returns, split adjusted, of course. My point is, high PE isn't a stop sign. It's a launch pad when growth accelerates in many cases. Number 2, Amazon. The PE was 3,700 plus, and it was too expensive until it wasn't. In the late 1990s, Amazon's PE soared past 3,700. Wall Street called it a bubble. Investors who ignored the noise and held through the dot-com crash, well, they had a very different experience, up over 150,000% since its IPO. Keithism here is that visionary growth tends to outrun temporary metrics. Think about it. Then there was NVIDIA. It was a $3 trillion monster, and it started at a PE ratio of 400. NVIDIA looked insanely overvalued at a PE of greater than 400 pre-AI boom. Fast forward, well, $4.5 trillion plus market cap. Early believers turned skepticism into generational wealth. Why? Because the key thing in this instance is that dominant tech trends rewrite the rules regularly. So don't apply outdated metrics and expect different results. Okay, how about Netflix? PE 500 plus. Streaming was just warming up. Netflix traded at a PE ratio above 500 during its pivot to streaming. Now, critics said no moat, right? But since then, 70,000 plus percent return since its 2002 IPO. Disruptive business models laugh at traditional PE ceilings and often leave investors who get hung up by those things in the dust. And finally, how about Apple? PE of 50 plus after the iPhone, overhyped? Yeah, became iconic post 27 launch, post 2007 iPhone launch. Now, many cashed out early, long-term OBA thinkers, one-bar head thinkers, Apple is plus 200,000% gains from its 1980 IPO, right? Ecosystem lock-in increasingly suggests that high PE ratios are a sign of perpetual growth, not looming disaster. So Keith's investing tip, this is a very harsh awakening for many, but PE ratios have zero predictive value whatsoever. Full stop. So don't make the mistake of thinking they do and treating them like a crystal ball. Instead, focus on refining your craft as an investor and or a trader. There's plenty of money to be made in both directions, up and down, and the right tactics help tremendously. And I'll have some of those thoughts again for the OBA family later today, by the way. Number 3, Microsoft has just put the frontier in frontier investing. First, Washington just greenlit Microsoft's export licenses to ship NVIDIA's new GB300 GPUs, roughly 60,000 chips, I think, to the UAE. Now, Microsoft is now the first U.S. company under the current administration to secure these kinds of export approvals, which means that every major AI model, OpenAI, Anthropic, or otherwise, running in the UAE will effectively run through Microsoft's pipes sooner or later. My POV, investors who still think software is all that are missing the forest for the trees. The more profitable path is owning the infrastructure that makes AI possible. And at this point, you know what to do. And if you don't and would like some help, I'll be here. Love to see you. Anyway, number 4. This makes me think, is Buffett's cash pile the perfect anti-indicator? Now, what do I mean by that? Well, Berkshire Hathaway's cash pile just hit a record $381.6 billion, if I remember right. And that's B with a B, billion with a B. But not a dime in buybacks. Now, most believe that Uncle B is loading up for a shopping spree because that's the palatable public story, or at least some version of that anyway. I think personally it reeks of paralysis. To be fair, I have long suspected Buffett's hoarding cash to spare his successors WWWD, as in what would Warren do syndrome once he's gone. That way they can act without ghostly second guessing him. But that goes way beyond. This goes way beyond dry powder, right? There's a fine line between being parked and being left behind, especially during one of the biggest technological transformations in human history. It wouldn't be the first time, unfortunately. Berkshire has missed plenty of big waves, from the rise of Apple until very, very late, to AI, to cloud, to clean tech. Now, I used to think that Berkshire would be fine post-Warren, but now I'm not so certain. KBW recently downgraded Berkshire, and I got to say, I'm hard-pressed not to agree. Cash is comfort, not strategy. Trade idea, by the way. In this department, I'd rather own the innovators that Berkshire won't touch, which is the anti-indicator part. Think Palantir, for example. And I'd rather do that than sit on a pile of cash that's someday money that never gets used. And finally, number 5, OpenAI signs with AWS, but the deal is really about NVIDIA. Now, OpenAI signed a $38 billion compute deal with Amazon Web Services, AWS, marking its first major partnership beyond Microsoft. Not surprisingly, Amazon is up big on the day. But the deal is really about NVIDIA. Let me put it this way. Hundreds of thousands of folks headed into the rugged California Sierras during the gold rush of 1849, but very few made anything at all. On the other hand, those selling picks, shovels, and whiskey made bank. So, Keith's investing tip in this department: think like the gold rush. The world's smartest, most successful investors know that they want to lock in supply before the next boom hits. You want to do the same thing with your money. Today's bottom line: there are two ways to play the game. Get in before the crowd equals bigger returns. Controlling risk ahead of time equals less stress. Either way, build confidence equals hold strong when others panic. You got this, I promise. As always, let's make it a wonderful day and start the week strong. Thanks for watching, and I will see you again tomorrow. Cheers.